Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to take a look at some financial statement disclosures related to accounts receivable to see where we could pull some information in order to calculate some key numbers that are not otherwise disclosed by the company. Let's get started.
For our disclosure example, we're going to look at TK Incorporated, which sells coin wrappers to the banking industry. Now, in case you're wondering, this is a disguised company. What I decided to do for all of these videos is take real companies' financial statements, but then disguise them by changing the names and making up different businesses, just so I don't get in trouble for inadvertently criticizing some company on the videos. Anyway, TK had sales for the year ended December 31, 2008 of $149,270. By the way, that's in thousands, so that's actually $149 million. We're going to use excerpts from the balance sheet and the statement of cash flows to answer the following questions for TK. What were their write-offs of accounts receivable in 2008? What were cash collections from customers in 2008? And by how much did a change in the estimated uncollectible percentage affect bad debt expense in 2008? Here's the operating section of TK's statement of cash flows for the years 2006, 2007, and 2008. And you can see that net income and cash flow from operations both dropped substantially in 2008.
Wow, it looks like TK had an awful year in 2008. Weren't banks buying coin wrappers that year?
Yeah, I'm pretty sure that most banks weren't using their government bailout money to buy new coin wrappers in 2008, which is why TK had such a bad year.
One more thing I want to point out on the statement of cash flows before we move on is the big negative number for accounts receivable in 2008, which is one of the big reasons they had negative cash flow. What this negative number indicates is that TK was booking more sales revenue and net income than they were collecting cash from customers, and this increase in receivables represents the non-cash portion of revenue, which has been growing substantially over the past 3 years. So it indicates that there is something big that's going on with their receivables. Here's the current asset section of TK's balance sheet. Of course, the thing we're going to focus on here is accounts receivable. The numbers that you see, the 12,930 and the 7,826, those are net receivables. And then we see in the disclosure that those are net of allowances of 1021 in 2008 and 220 in 2007. So here again, we see an issue where the allowance for doubtful accounts has grown substantially in 2008. So the first question we're going to answer is, what were write-offs of accounts receivable during 2008? Over here on the right, I have the allowance for doubtful accounts T account, and we're going to start filling in what we know. So we can fill in the beginning and ending balances, and of course it's a contra asset, so they're on the credit side. Now we need to find either bad debt expense or write-offs. Once we find one, then we can solve for the other. Back on the statement of cash flows, there was a line item for provision for doubtful accounts of 1558. So bad debt expense goes into net income, but it's a non-cash expense, so it has to get added back on the statement of cash flows. So we can see what the bad debt expense is. We plug that into the T account, and now the only thing missing is write-offs, which we can solve for. So if we take the 220 beginning balance plus 1558 bad debt expense minus the ending balance of 1021, we end up with write-offs of 757.
I believe you're mistaken. If there were any recoveries, you would need to also include them in the T account. These write-offs are really write-offs net of recoveries.
Nice catch. We should also have recoveries flowing through this T account. So if there were any recoveries of prior write-offs, then what we're really picking up is write-offs net of recoveries. Good job.
Next, we're going to calculate TK's cash collections from customers in 2008. I've put the accounts receivable T account over here on the right, and we're going to fill in everything we know and see if we can solve for collections. We'll start with sales. Sales for TK for the year ended December 31, 2008 were $149,270. I gave that number to you when I introduced the example. Of course, you could have also gotten it from their income statement if you had it. Sales increase accounts receivable, so we put this on the debit side of accounts receivable. Next, we want to try to fill in the beginning balance. The beginning balance is not the 7826 that you see on the balance sheet excerpt, because that's net of allowances. So we need to add the 7826 plus the allowance of 220 to get gross receivables of 8046. We'll do the same thing for the ending balance. We'll take the 12,930 on the balance sheet, which is net, add the 1021 of allowances to get gross accounts receivable of 13,951. When we answered the prior question, we calculated that write-offs were 757, so we can fill that in. And now the only thing that's missing is cash collections. So if we take the beginning balance of 8046, add sales of 149,270, subtract the write-offs of 757, and subtract the ending balance of 13,951, we end up with cash collections of 142,608. Now note that the difference between the sales and the cash collections is 6,662. Where have we seen that number before? Well, that was the number on the statement of cash flows for the increase in gross accounts receivable.
That seems like a lot of work to get cash collections. Don't companies just disclose this number somewhere in the financial statements?
Actually, no. Most companies don't explicitly disclose cash collected from customers, and the only way to figure it out is to work through the T accounts.
Pardon me. Before you continue, may you please explain why you can use total sales and not credit sales to do this calculation?
Yeah, dude, you had, credit sales in the T account in the earlier slide.
Okay, I'm going to do a quick digression to show you that we can calculate cash collected from customers using total sales. We don't need the breakdown of cash sales and credit sales to do it.
Here is the accounts receivable T account with everything that we've talked about that flows through that account. And then we've got the sales T account down below. So let's just say, for example, that there are no write-offs or recoveries so that we don't have to worry about them during this example. Now, even if they weren't zero, all the answers would be the same. It just makes it easier to do the math. Now what we're going to do is have our beginning balance of accounts receivable 100, our ending balance 200. We're going to assume that we had 500 of cash sales and $1,000 of credit sales. So that's a total of $1,500 of sales. And notice we put the $1,000 of credit sales into accounts receivable. Now the only thing that we don't know in the accounts receivable T account is cash collections. So we can solve for that. If we take the beginning balance of 100 plus $1,000 of credit sales minus the ending balance of 200, we end up with cash collections of 900. So how much cash should we collect from customers total? Well, we got $900 cash collecting on accounts receivable. We got $500 of cash directly from cash sales, which is a total of $1,400 of cash. Now the problem is that if you look at real financial statements, companies will never disclose credit sales and cash sales separately. So we need to find a way to do this without having this breakdown. But the good news is all we have to do is use total sales instead of credit sales and everything will work. So remember this cash collection from customers of $1,400 and let's see if we can get that by just using total sales. So we go back to our example. We have a beginning balance in receivables of 100, an ending balance of 200. And now we're just going to work with total sales. So we saw before that total sales were 1,500. So we plug that into accounts receivable and then solve for cash collections. So we have 100 plus 1,500 minus 200 gives you cash collections of 1,400, which is the same number that we got before. So essentially what we're doing is by putting total sales in accounts receivable, we're combining the cash and the credit sales, but then the cash sales just show up also as part of the cash collections, and we get the same answer that we would by knowing cash and credit sales separately. So the good news is you don't need to know credit sales to calculate cash collections. You can just plug in total sales in accounts receivable and you'll get the right answer.
Okay, let's get back now to our disclosure example.
The last thing we're going to do with the disclosure is try to uncover the effect of the change in bad debt expense due to TK changing the estimated percent of its uncollectible accounts. To do this, we first have to compute the percent of gross accounts receivable that are expected to be uncollectible accounts. We're going to calculate this percentage by dividing the allowance by the gross accounts receivable, which of course we've talked about is the net accounts receivable on the balance sheet plus the allowance. Now I know this is not one of the two methods we use to come up with bad debt expense, but the fact of the matter is companies usually don't disclose enough information in their report that you could use one of those two methods. So as a quick and dirty approach, I like to just divide the allowance on the balance sheet divided by gross accounts receivable to figure out what percent of their gross receivables on average are expected to not be collected. So using TK's number, in 2008 we saw on their balance sheet the net receivables were $12,930. They had an allowance of $10,21, which is gross accounts receivable of $13,951. If we take the allowance of $10,21 divided by the gross of $13,951, we find that their estimated percent of uncollectible was 7.3%. If we do the same calculation in 2007, we come up with 2.7%. So we can see that TK increased its estimated percent of uncollectibles quite substantially from 2.7 to 7.3%. The question is, what would their bad debt expense have been if they had not increased their rate? So to do this, we want to apply the 2.7% from 2007 to the gross accounts receivable in 2008 of $13,951 to get an expected balance of the allowance of $377 that TK would have had if they had not increased their estimated uncollectible percentage. As a final step, we want to compare this $377 to the actual allowance that they recorded, which was $1021. And what we can find is that TK increased their bad debt expense by $644 due to their increase in their estimated percent of uncollectibles from 2.7 to 7.3% during 2008.
Not really math. Dude, but, like, when would we, ever have to do this calculation?
If I was concerned that a company was manipulating its earnings to try to meet some kind of earnings forecast, this would be one of the first places I would look, because it's a fairly easy and opaque way to increase your earnings by just tweaking downward the estimated percent of bad debts. Now, in this case, the company increased the percentage, which hurt their earnings, but if the percent had gone down, it could have really helped their earnings. In fact, to show you how a decrease in this percent could help their earnings, let's do the same calculation for 2007.
So let's run this back the other way and figure out how 2007's bad debt expense may have been affected by having an abnormally low percentage of uncollectibles in 2007. Maybe what TK was doing is they should have increased their percent of uncollectibles in 2007, but they kept it low to avoid signaling the bad news. So to calculate what the bad debt expense would have been under the 2008 rate of 7.3%, we just take the balance in gross accounts receivable in 2007, 8046, times the 2008 rate of 7.3%, and come up with an expected allowance of 587. Then we compare that to their actual allowance of 220 and see that TK avoided $367,000 of bad debt expense by keeping its estimated percent of uncollectibles very low. Now, I'm not saying that TK manipulated their bad debt expense percentage in 2007. It could have been they hadn't gotten bad news, the economy hadn't gotten bad yet. It could all be legitimate. But if you have any concerns that a company may be manipulating their expenses and hence their earnings by playing games with their bad debt expense, this little calculation will help you uncover how much their earnings were affected by using a different percent of uncollectibles than they had in a prior or future year.
And that wraps up our look at what information we can pull out of an accounts receivable disclosure, and it wraps up our discussion of accounts receivable. Join me next time as we start to dive into inventory. I'll see you then.
See you next video.